Hello, traders and investors. Hope you are all well. Welcome back or welcome to my YouTube channel, and my channel name is Rohit Mandrawal, where you will learn about stock market and trading. Today we will talk about drawdown. I believe you have heard. If not, don't worry, there is a video for you about it. Let us begin the video without further ado. What exactly is a drawdown? A drawdown is a peak-to-trough decline in an investment, trading account, or fund over a specific time period. A drawdown is typically expressed as a percentage of the difference between the peak and the subsequent trough. If a trading account has 10,000 rupees in it and the funds drop to 9,000 rupees before rising back to 10,000 rupees, the trading account has experienced a 10% drawdown. Drawdowns are useful for assessing the historical risk of various investments, comparing fund performance, and tracking personal trading performance.
Because a trough cannot be measured until a new peak occurs, this method of recording drawdowns is useful. As long as the price or value remains below the previous peak, a lower trough may occur, increasing the drawdown amount. Explained. The drawdown? A drawdown continues as long as the price is below the peak. In the preceding example, we don't know the drawdown is only 10% until the account returns to 10,000 rupees. The drawdown is recorded once the account rises above 10,000. Because a trough cannot be measured until a new peak occurs, this method of recording drawdowns is useful. As long as the price or value remains below the previous peak, a lower trough may occur, increasing the drawdown amount. Drawdowns aid in determining the financial risk of an investment. The Sterling ratios compare a security's potential reward to its risk using drawdowns. A drawdown is the inverse of the standard deviation in relation to the price of a stock. The amount drawn down from a share price's high to low is referred to as the drawdown amount. If a stock falls from 100 rupees to 50 rupees and then rises to 100.01 rupees or higher, the drawdown was 50 rupees, or 50% from the peak. Stock reductions. The standard deviation of a stock measures its total volatility, but many investors, particularly retirees withdrawing funds from pensions and retirement accounts, are concerned about drawdowns. Volatile markets and significant drawdowns can be difficult for retirees. Many investors consider the maximum drawdown, MDD, of their investments, ranging from stocks to mutual funds, in order to avoid those with the largest historical drawdowns. Drawdown danger. When considering the increase in share price required to overcome a drawdown, drawdowns pose a significant risk to investors. For example, a stock losing 1% may not seem like much of a loss because it only needs a 1.01% increase to return to its previous peak. A 20% drawdown, on the other hand, necessitates a 25% return to reach the previous peak. A 50% drop, as seen during the Great Recession of 2008 to 2009, necessitates a whopping 100% increase to re-establish the previous peak. Some investors prefer to avoid drawdowns of more than 20% before cutting their losses and turning the position into cash. I believe there is a lot of information in today's video. I hope we can meet again for a future or new topic. There, I'll tell you all about the stock market and trading. Subscribe to my channel and like my videos for more information, and I'll see you soon. Bye.